Hey everyone, and welcome back to the channel. In today's video, I'm going to be sharing how you can buy your first home with little to no money. So this video is going to be segmented into two different parts. For the first part, we're going to go over the different strategies to save on your down payment. And on the second part, we're going to go over the different strategies to save on your closing costs. Because when you're buying a home, these two things make up your cash to close or the total amount of money you'll need for the home purchase. So I want to make sure that you guys know both strategies, not just strategies on how to save on your down payment and not just strategies on how to save on your closing costs. If you guys want the maximum amount of savings, you need to know the strategies for saving on both. And that's what we're going to cover in this video. So let's go ahead and hop into the different strategies that you can use to save on your down payment. All right, number one is simply knowing that you don't need to put 20% down. There's plenty of programs out there that have minimum requirements for first-time homebuyers of 3 to 3.5% down. And even if you do have the money for 20% down, if you work out the numbers, you will see that it's better to keep that money in your bank account, to invest in other things or maybe just to have for reserves instead of putting it into the home. And I've made videos on it. I'll link it right here, breaking down the exact numbers. But essentially what I've shown my clients is, hey, if you put 20% down in the case you do have the money, you're going to be saving maybe $500, $800 a month, which is a lot of money, but you're going to have to put an extra $100,000 or $150,000 down for this home. And I don't know, but for me, I'd rather keep those $80,000, $150,000 in my bank account and pay a slightly higher mortgage payment than to have little to no reserves in my checking and savings account, right? You never know when you're going to run into a rainy day, maybe you're going to need a roof, etc. So that's the first thing to understand, is that you don't need 20% down. And even if you do, it's best not to put 20% down. But of course, consult your mortgage loan officer and have them break down the numbers for you. All right, number two is down payment assistance. This is a great way to cover the entirety of your down payment for an FHA or a conventional loan. Now, the way these work is that they're not their own individual special program. It's simply where an organization or a bank helps you cover the minimum down payment on an FHA or a conventional loan. So anyone that gets a down payment assistance program is getting an FHA loan where the bank or organization covered the 3.5% down payment, or a conventional loan where the bank or organization covered the 3% down minimum down payment. So that's essentially how they work, and there's three different types. So it's very important that if you are moving forward with a down payment assistance program, you know which one you're getting. The first and most common is the loan. This is where the bank or organization is going to give you the 3 or 3.5% down, but when you go to sell or refinance the property, you have to pay that money back. The second type is a forgivable loan. These are not that common, and this is where the bank or organization is like, hey, after you do XYZ, we'll forgive the loan and you don't have to pay it back. And then the third type is the grant. This is where they give you money, it's essentially free money, and you don't have to worry about paying it back. Now, some of the common requirements that you'll see amongst these down payment assistance programs is that they'll have an income requirement, meaning you can't make over a certain amount of money in order to qualify for these loans. And oftentimes the problem with this is, let's say you want to buy a home in LA, you need to make roughly about 150 to 120,000. And some of these programs will be like, hey, in order to get this assistance, you can't make more than 80K. Another requirement is you need to be a first-time home buyer, meaning you can't have owned property in the past 3 years. Of course, every down payment assistance program doesn't have their own specific requirements, so I won't go over all of them. But the last thing I do want to mention about down payment assistance programs is oftentimes the catch is they come with a higher interest rate. For example, right now in my company, we have a down payment assistance program where you'll get 3.5% down for your FHA loan. That's what they'll help you with. It's a grant, so you don't have to pay that money back, but your interest rate is going to be about 2 to 3% higher than what's at market. So let's say at market we're at 6%, you're going to get an 8% or 8.5%, right? Which of course means a higher mortgage payment, and it means you're going to qualify for less loan. All right, number three way to save on your down payment is through the standard first-time homebuyer programs. Like I mentioned, a first-time homebuyer is someone that hasn't owned real estate in the past 3 years. And the standard homebuyer programs that I recommend are FHA with their down payment of 3.5% and conventional's 3% down minimum for first-time homebuyers. Those two are great because unlike the down payment assistance options, they don't have income requirements and you aren't going to get a crazy high interest rate. So these are very, very, very great programs if you're a first-time homebuyer. I won't go over into the specifics, but these are great programs where you can put 3 or 3.5% down. All right, and the fourth way to save on your down payment is through gifts. So if someone in your family, let's say your parents, your siblings, maybe your daughter, your son, whatever, wants to help you purchase your first home, they can do that, and that money can go toward your down payment. For example, let's say I want to buy a home using an FHA loan. My parents can help me with the entirety of the down payment, the entire 3.5% down, and I don't have to put any of that money. Of course, they have to be willing and interested in helping you guys out, but it's something that a lot of people don't know. So if you have family like your parents, your siblings, call them up and be like, hey, I want to buy a home. Can you help me buy a home? You never know what they're going to say, right? But that's something that a lot of people don't know about that can greatly help you in saving thousands and thousands of dollars. All right, for the second part of this video, now we're going to go over how to save money on your closing costs. So starting with number one is seller credits. What is a seller credit? So a seller credit is essentially where a seller agrees to pay for a portion or all of your closing costs. Now, it's very important to understand two things when it comes to the seller credits. Number one is that it's very important that you work with a great real estate agent, because they're the ones that are going to negotiate these seller credits. And if you have an agent that's not a great negotiator, doesn't know how to negotiate, chances are they're going to get you very little or no seller credits. So think about this when you're choosing a real estate agent. The second part that's very important to understand about seller credits is that every program has a different limit on how much you can actually receive from the seller. For example, if you're getting an FHA loan, the limit is 6% of the purchase price. On a conventional loan, when you're putting less than 10% down, it's 3% of the purchase price. And if you're getting a VA loan, it's 4% of the purchase price. And for any non-QM programs like bank statement, ITIN, jumbo, etc., it's going to be a limit of 6% of the purchase price. So make sure you ask your loan officer when you get your loan, when you get your pre-approval, hey, what's the maximum amount of seller credits that I can receive on this loan program? And you communicate that to your buyer's agent. All right, number two way to save on your closing costs are through lender credits. A lender credit is essentially where a bank offers you a higher interest rate in exchange for money toward your closing costs. For example, let's say interest rates are at 5% and for whatever reason, you don't have enough money for your cash to close your closing costs, right? Hey, Bob, I'm short $2,000 to $3,000 on my closing costs because an emergency came up. Bob can be like, okay, good. You have a 5% right now. The bank is willing to give you $5,000, and this is just an example, if you get a 5.5 interest rate, right? A higher interest rate. And the bank's gonna give you those $5,000 for your closing costs. So it's a great thing to do if you need that money or if you wanna come in with less money in closing costs. And because it is gonna come with a higher interest rate, you are gonna pay a higher mortgage payment, more in interest. But if you're just gonna be paying an extra $50 or $70 and you're gonna get $5,000 for your closing costs, that's not a bad deal. Right, so ask your loan officer about these lender credits so you can save money on these upfront closing costs. All right, number three, and this is mostly if you're working with a mortgage broker. For the most part, number three is going lender paid. What does that mean? Well, when you're working with the loan officer, they're either doing your loan as a lender paid loan or a borrower paid loan. What does that mean? With the borrower paid loan, that means that you, the borrower, are paying the bank's fees or the bank's commission up front. So let's say it's $10,000, you're paying those as part of the closing costs. On lender paid, that means you're not paying those fees up front. The bank or the lender is essentially financing that into the interest rate. So what that means is on your closing costs, the bank fees are going to be close to zero and your interest rate is going to be higher. If you're someone that wants to put as little as possible in your closing costs, ask your loan officer, hey, can we do this lender paid if it isn't already lender paid? That way I can save money on my closing costs by essentially financing those bank fees into the interest rate. Of course, this is going to come with the higher interest rate. You're going to pay more interest over time, but you can save $5,000 to maybe even $20,000 in closing costs by going lender paid. All right, and the fourth way to save on your closing costs is, of course, gifts. Like I mentioned earlier, one thing that you can use toward your down payment and your closing costs is a gift, which is great. It just needs to be from a family member, and in some cases, I believe for FHA, it could even come from your employer. So that's pretty much it. Hopefully you guys enjoyed this video on the different ways that you can save money on your down payment and your closing costs. If you enjoyed it, leave a big thumbs up, comment down below, and share this with your family that's interested in buying their first home. Thanks again. See you in the next one, and be great.